Can I ask how old you are?
41.
I'm just a year older than you. We're the guys that hustled early 20s and got burnt out.
Yeah, you were talking about COVID. I feel like COVID definitely burnt me out, but you have to get through it. And I think last year was really tough from real estate perspective in general. And hopefully we're starting to see the sun shine again, but we'll see.
Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting.
Every week I try to get the best guests I can find in the real estate world, and today we have Sam Bates with us. Sam, welcome to the show.
Thank you for having me on. I'm excited to talk to you and also hopefully share wisdom and nuggets with your listeners.
For sure. It's been a busy year already. We're in January and it's been a crazy past few years. I always like to start with how'd you start out in real estate and then how'd you make it through COVID the past couple years? And then we'll get into what you're doing right now. Hit me with the good stuff.
Yeah, definitely. I was undergrad in finance, worked at investment bank and private equity shop for a couple years. Then after that, I got my MBA and master's in financial planning. I thought I was going to go that direction. The market crashed in '08, so I started working at a consulting shop and quickly realized I didn't want to do that for 40 years. So I started investing in real estate as a limited partner on 2 apartment deals and a hotel deal. And none of them really went the way it was planned and performed it out. So concurrently, I guess in 2010, I started investing in single family on my own. After about 15, 20 single family buy and holds, fix and flips, a spec build, I decided to look at buying multifamily and buying small multifamily for myself. I ran into a guy who became one of my partners who we used to work together at one of the consulting firms. And we started looking for small apartments to buy and raise capital for. We kept getting the same answer from brokers that we were too young, that they couldn't trust that we could raise money.
How old were you then?
I was in my 20s at that point, maybe early 30s. He knew a guy who had been a home builder. So we brought him in and we built our first development was 60 unit apartment and 10,000 retail space. And that kind of catapulted us. And really since then we've either bought or built over 1,000 units. We have another 75 million in development right now. We build about 150 single family homes a year. We have 4 or 5 companies all integrated in the real estate space. We're pretty much vertically integrated except from a property management standpoint.
That's wild. That was unexpected. And I read your bio, but it sounds so much better coming from you. So that must have been wild. Go back to your first development. So you guys went from 0 to 200 miles an hour. How long did it take you to pull that deal together? That must have just been insane.
Yeah, luckily we were a little naive, and I think we didn't know what we didn't know, obviously. And raising the capital, it was like a $2.5 million equity raise. And it was by far the hardest we had just because we didn't have a track record. And we went to family and friends and business associates, and we kind of scraped and pulled and finally got that together. And through the process, we dealt with obviously the city for the first time, and they tried to change a lot of different zoning on us, and we had to get it rezoned, but they tried to reduce our unit count because of the acreage. So we had to buy some additional acreage right next to it. There was a lot of learning and growing pains, but I feel like almost in any development, you're going to have that. Simultaneously, or about a year in, we started doing a land development that was 200 acres, and just going through, this is kind of random, but like we had to run utilities through one of the landowners' yards, and we had to pay him an additional $240K just to get the utilities through. you don't really know. Even if you are prepared and have the best plan, you're going to have to pivot and make the best of it.
Yeah, development, construction, ground up, that is like the most tenuous, like difficult hedge. It's just over so many years. How long did that original project take you from start to finish?
The retail space we were able to build and sell in roughly 2 years. We could have sold it before, but we wanted it to be stabilized for a year and then we sold it. And then it took us 2 to 2.5 to start leasing up the apartment. And we actually kept it until middle of last year. So the whole period for that was about 7 years.
Bravo.
Thank you.
And through the thick of it too with COVID. And
Yeah.
so yeah, you were lit by the fire, or you just had to go after it. That's great. Tell me about your markets that you're practicing in.
Typically went to the secondary and tertiary markets. We found that we can't compete against Trammell Crow or JPI or any of these big boys in terms of economies of scale and even resources. So we've always been outside of the DFW proper, or like that apartment development was 65 miles northwest of San Antonio. We've bought apartments in Mississippi, and secondary markets, Atlanta, secondary markets, Orlando, places an hour and a half, 2 hours in any direction in DFW. And we were finding a lot of value and a lot of yield, especially 3, 4 years ago. Now with cap rate compression, I'm probably not going to go back there, or decompression, but we were picking them up at 6, 7, sometimes 8 caps and selling them. I mean, the lowest we were able to sell was for a 4.9 cap, which
Gee.
obviously that's going to add a ton of value. Now that's not going to be the case, but I think we were smart in the locations we went kind of before most people were buying, or at least a lot of the people in our circles in Dallas were looking at.
It's incredible. I bet you have some good mentors.
I was in a group, one of the first real estate groups back in 9 to 11. But really, since then, it's just been me and partners. And obviously, I listen to a ton of podcasts and read books constantly. But from a true mentor standpoint, it's just been a lot of self learning.
Yeah, that's great. Well, they got you there.
Yeah, and I mean, my partners, I can't even swing a hammer, but he's been a general contractor. He's been phenomenal to work with. If it wasn't for him, I mean, we wouldn't be developing. So we've definitely had, I wouldn't call them mentors, but partnerships that have been exponentially wonderful for both sides.
Yeah, thank you. I've done some different stuff in my past. So I developed hotels, medical office buildings, retail, some pretty big stuff. Now I manage a fund. We do multifamily primarily. We share some good similarities. Ground up construction, though, I mean, I was on pins and needles for that whole time period, and getting water taps and all these teeny tiny things that you don't imagine. But I'm bringing that up because the investors that you're attracting and those folks, they have to visually trust you and see that you're going to do something in the next 5 to 7 years. How do you make an investor secure with all this stuff going on? How did you keep them secure when COVID was happening? You obviously got a lot to handle. That might be a deep question, but tell me.
No, it's a great question. And I would say 95% of the investors we know personally on a fairly deep level, and they know the type of people we are and just our character. So that's been really helpful. But we also have investors that are retired. They might need cash flow, so they don't want to invest in a development. They want just a cash flowing asset. We've had different iterations where we'd raise money from the very start and take the land down and go through zoning. And we've realized a lot of those investors, that was almost too long of a hold period. So in the last couple of years, we've raised funds where we take down the land and we do all the horizontal construction. They'll get a return, then we'll sell it to another entity. So the investors that don't want to take on that risk will come in a little bit later in the process. And then the investors that went through us with the horizontal construction can roll over to the vertical construction. And I think it's just constantly talking to them. We communicate with our investors, I think, more than most groups do. And I've had some of my friends say you communicate way too much, but we want to we want to tell them, what's going on. And if there's something bad that's happening, which inevitably it will, especially in development, there's just certain things that's out of your control. We want to tell them to make sure they feel as comfortable as possible with their investment.
That's awesome. Communicating too much is definitely not a bad thing. Call them before they call you type thing. I got to ask, is it mainly accredited investors, like family offices? How do you get your capital?
We've done all high net worth individuals. We started out with 506B. In the last few rounds, we've done only 506C. But I grew up on a farm. My family are mainly teachers or farmers. And one of my goals was to try to create as many millionaires as I possibly could. Obviously, going that route, doing 506C would be difficult. So that's why we did 506B.
Can you tell me the difference? I mean, I know the difference, but for the listeners.
Yeah, 506C, you have to be accredited, and the main ways you're accredited in the SEC's eyes is if you're single, you make 200,000 plus for 3 years in a row, or if you're married, it's 300,000 and you expect to continue, or you have a net worth of 1 million less you're not including your primary residence. And then 506B, you can take non-accredited investors, but they have to be considered sophisticated, which that's very subjective on what sophisticated is, but you can only take up to 35 non-accredited investors. So we've always had accredited investors in our syndications and funds, but the last few we've done, our attorneys highly stressed going the 506C route. So we've done that. I'm not sure if we'll go back to the 506B, but at this point, we've never dealt with institutional capital. I would love to. I've heard there's a lot of strings attached that we just haven't luckily had to deal with at this point.
That's great. Thank you for that. So my fund accredited investors, Reg D, and we're not dedicated to one property. So like my fund, we have 20% lending and then 80% of it is fix and flips or buy and holds. We get in and out of them and they're smaller assets. But let's talk about that. What kind of assets specifically are you looking for unit wise, any of that buy box stuff?
It's kind of changed over the years. Obviously, when we started out, it was smaller, but we bought anywhere from like 48 to we're doing one development that's 257 units. Right now, we're building an 84 unit apartment, student housing, which is 252 beds. We're building a 124 unit apartment, another 124. We're trying to get 127, but waiting on the city to come back. I would say playing in that 100 to 200 unit space. We'll go in some of the land developments that we do, and then obviously that's smaller. But from a multi-family standpoint, trying to look at 100 plus just to get more economies of scale with a property management team.
Thanks for that. How many units altogether?
We've sold a lot. Luckily, we sold at the right time, but I would have to count at the height we had 1,035. Now we're down to 300 and some odd, and now we're building another over 300.
Bravo, man. That is incredible. Can I ask how old you are?
41.
Sweet. I'm just a year older than you. So
Oh, awesome.
we're the guys that hustled early 20s and got burnt out.
Yeah. Yeah. You were talking about COVID. I feel like COVID definitely burnt me out, but you have to get through it. And I think last year was really tough from real estate perspective in general. And hopefully we're starting to see the sun shine again, but we'll see. I mean, transaction volume was down, depending on the market, sometimes 70, 80% last year.
Yeah, I agree. Our fund, we raced to get it off the ground right before COVID. And like, obviously, we didn't see anything coming. So we were spending so much on legal fees and expediting it. Then COVID hit, and we took a whole year-long break before we launched our fund, just kind of watching what was going on. How did you make it through? How crazy was it with investors? Can you share some of the specifics? Because that's new construction and that's not easy. You got high interest loans. You have to, give capital. Some of your promises change, and none of this is negative. That's what happens in big development, right? Big, big, big wins.
Luckily, from an apartment standpoint, timing was pretty impeccable from a COVID perspective. We only had one development going, but it definitely was difficult. Like we had to wait 5 months for windows. So construction just halted. The cities obviously they always respond slow, but they were responding even slower. that specific city, there was a pipeline bust. So all the engineers went and worked on it for 6 months. So we lost a lot of time, but we built it. It's now stabilized. We're actually selling it right now. We did well from a development side, but we did have probably 7 or 8 assets that we were operating. Some of them had met their maturity, so we sold them. But the ones that we kept, it seemed like in Texas, we weren't impacted that much, but like in Mississippi, we were impacted severely until we got rent relief. I know talking to other operators in different states, it was all over the board. Our property in Georgia, I mean, we've always had a little bit of delinquency just because it's Class C, but luckily that delinquency didn't skyrocket. I think we were pretty grateful in the grand scheme of things of how it went. We have 3 assets in Dallas, and being pro-friendly, landlord-friendly state, you would think we could get them out quick, but the hardest tenant base to get out was the properties in Dallas because that one specific judge in that precinct was treating it. She was from California, and she was treating it like COVID rules in California.
Interesting you bring that up. So landlord friendly states and non-landlord friendly states like California and New York are totally different animals than Texas and Pennsylvania. I'm in a very landlord friendly state. It is one of the main reasons we have the success that we do. Some people don't understand it. There's so many big dollars in different places, but this is one of the biggest matrix that we rely on because we've had tenant issues and we buy a lot of class B, B minus, maybe C plus properties, and you have to make tenant changes and things like that could just crush in other locations. You want to touch on that?
Yeah, I completely agree. One of our, I guess, requirements is to invest in landlord friendly states. I won't go to California or New York, like you mentioned, just because that fact. Since COVID, it seems like it's becoming more and more local and jurisdictional. And like in Georgia, luckily we aren't in this county, but one of the counties next to us, their government, I feel like they went crazy and they aren't evicting anybody. So I hear people have 30-40% delinquency because the tenants aren't afraid that they're going to get removed. But as a landlord, I don't see why you would invest in somewhere that doesn't want you to succeed, doesn't have your back. It's hard enough dealing with people in a landlord friendly state. So having to deal with one where tenant, and this sounds bad, but where tenants' rights are significantly higher than your rights, it's hard to operate a business.
Yeah, I agree. Hitting returns. It's a requirement, right? If you're going to be in this type of a game, you have to make sure your investors are happy. Can you just chat about that? Are you like currently right now, are you guys distributing returns? Are you able to? How's the temperament?
Right now, we aren't distributing. We stopped, I guess, last year, and we might start again. But there's so much speculation on what the Fed's going to do and interest rates and if it's going to drop. I mean, after the Fed spoke last time, everybody thought rates were going to drop at least 3 times this year. The more I read now, I mean, there's a 1% chance that they are going to drop in March. So
Yeah.
what was said and what people heard, I think, are completely different. And we're just building up a war chest with our properties. And a couple of our properties we're selling. A couple of properties we refied, returned to over 100% to our investors already.
And how long of a period did that take?
From like 19 to 20 or 19 to 21, or like one was we bought in 21 and refied in 22. So it just kind of depended on
Can you explain that? That's such a big deal just for somebody who maybe doesn't understand that, who's newer in real estate.
Definitely. And this is one reason I love commercial real estate over single family, because residential values based on the comps and commercial values based on your profit and loss statement or T12 or however you want to call it. But the value you add and the NOI you get, which is either increasing income, decreasing expenses, or a combination, you add value based on a cap rate. And obviously cap rates can change. But for one instance, we bought an 81 unit property. We went in, renovated all the units, and we were able to get a value where we could refi the loan, return all the initial invested capital to investors with a new loan because of the value we created. Another property, we did the same thing, but we were only able to return like 55 to 60%. So it doesn't always equate to 100% return, but as long as you can pull out a large chunk of equity and return to your investors, those are going to be your two biggest paydays for an investor is it the refinance or sell. And cash flow is great, but you're only returning over a year 6, 8, 10% on a good deal. So the cash out refi and the sellers where they make their biggest return on investment.
Thank you for that. So, how about tomorrow and the future? I do love talking about how crazy things have been historically, and I'm kind of a nerd with like what happened in the 30s, 40s, and watching the early 80s. And I did a bunch of webinars recently on how people were still borrowing money and building in 1984 and 83 and 79 and all these times that things were really, really crazy, borrowing at 16, 18% and still having success, and how we complain and there's just so much fear. And it's like, can't think about now with this. You got to look at the history. What are your thoughts for the future? Want to know how you're thinking.
If I could predict it, I'd be a billionaire. But I do think talking to investment sales guys, debt brokers, there could be a pretty hard crash in just existing properties. So many people took out loans in 2021, 22, and then they added pref equity or mezz debt. So they're highly levered. Those loans are maturing. They might be able to restructure it with the lender if the lender's willing to extend it, but it's finally going to come where they have to pay the piper. And where they were buying at top of the market, and now depend on which market you're in, but prices have dropped 10, 15, some have probably dropped 30%. I've heard a lot of people are saying they're trying to refinance, but they're completely underwater. And I don't know if that's going to hit this year. I don't know if that's going to hit next year, but it could be bloodshed in the
No, yeah, blood on the streets. That's the big term that all fund managers use. Let me explain what that means. So, blood on the streets, like wounded ducks. And then the other great term is dry powder. We're all just holding on to money, waiting to hopefully significantly increase our chances of success and reduce risk for the next 5, 7 years if we do this right.
And I think you're smart in having the fund and you can deploy capital quickly because this year, our main goal is just to quote unquote stabilize. I mean, we're building 3 properties and we might look at acquisitions in the Q2, Q3, Q4. But right now, I still think pricing is kind of in a flux. And I don't know if it's going to drop even more or not. And a lot of the investors we talk to are just on the sidelines. And people are irrational, even though it could be a phenomenal buying opportunity with all the carnage and wreckage that's happened the last year or two. People are concerned and afraid to give you money. Luckily, the last fund we raised, we closed out in 22, but all last year I was talking to people and it was taking 5, 6, 7 times longer to raise equity than it did previously. And unless we find a phenomenal screaming deal, I don't think we're going to be a buyer right now. Hopefully later in the year, but we'll have a better viewpoint of how the Fed's viewing the economy by then.
Yeah, thanks for that. That is great. Kind of waiting, watching, and seeing is all somebody in our fiduciary duty in real estate. If you have investors, is the best thing to say no and wait. How many deals do you look at in like a given couple weeks? And are you penciling most of them?
I haven't underwritten an acquisition since 21, to be honest with you. From a development perspective, we spent 6, 8 months last year, well, 22 and 23 on 2 new developments, both in Texas, one in Houston, one in a secondary market. And they penciled, and then the higher the rates got, they just didn't make sense. But from a development standpoint, we can do a lot more deals with fewer underwritings and looking. But from an acquisition standpoint, I'm usually underwriting 100 to 200 deals before I can get one. That might change now since
Yeah.
there's less buyers, but probably from 18 or 19 to 21, that was definitely the case.
Yeah, that's also the fun part about this business is like grabbing for straws every single day and
Yeah.
seeing which one sticks.
It's fun, but over time you definitely get burnt out. And then like in 21, the deals we bought, I'm
Yeah, that's a good way to put it. So last couple questions. We're coming to time. How about personally, family, friends, kids, wife?
Yeah, I don't have a wife or kids. I do have a girlfriend.
How do you keep yourself motivated? You're doing so much.
I've always had internal drive. I don't know what it is, but my internal fortitude's always been pretty high. And I am a Christian. And I think God placed on my heart a long time ago. One of my gifts is to help people. And I look at this as a way to directly help people by providing better housing. Obviously, we're getting a return, but our investors, I mean, some are very grateful. And when we've provided better returns than the stock market has to them, it gives me a lot of joy. And luckily, in real estate, if you are successful, you get rewarded sometimes more than you deserve. And I've been able to give to different organizations and church and things that are near and dear to my heart.
That is an awesome answer. Thank you for that. I'm Hindu, but I went to Catholic school my whole entire life. So I have a profound respect for Western religions. But you're bringing up a good point. I don't think enough people think of it like, oh, what are these investors doing just making money with real estate? I like to say, like, look, we're paying for taxes for the tenants' kids to go to school. We're putting a roof over their head. We are not trying to be slumlords. There's plenty of people that do. We have insurance on our properties. Like, we're healthy. And those families are creating, my slogan is like their most cherished moments in the facility that you created. And there's no like dollar amount on hide and seek when you're a kid in the house that you're growing up with and stuff. So I agree, man.
Since you're a developer, I don't know if you've thought about this or not, but when I was in consulting, I did property tax. So I sometimes go back and think about that. It's so frustrating how long it takes to get a development going. But like one of our developments, we're giving $800,000 a year to the county in property taxes. And it's like just that. I don't know how it's helping people out, but somehow it is.
No, it is. It has to.
Granted, I'm not a fan of big government, so I wish it could be allocated elsewhere, but it's doing good for the city and county.
Yeah, definitely. Great point. Great point. I give you Tejas Go Sign, Real Estate Investor MBA, give you the biggest stamp of approval we can.
Thank you.
I think honesty and trustworthiness is like, that's the commodity right nowadays. And you have both of them, and you've obviously done a lot with a lot of money. How does someone invest with you? Where do we go to get a hold of you?
Yeah, definitely. Well, thank you so much. That means a lot. The easiest place is to my website, basecapitalgroup.com, and you can sign up. And I have some free resources. It talks about not only real estate, but just investing in funds and private placements. So hopefully that's beneficial to your listeners.
Amazing. Again, big stamp of approval. Sam, thanks for the great discussion.
Yeah, thank you for having me. It was awesome.
For sure. Hey guys, this is Real Estate Investor MBA. That's Sam Bates. I'm Tejas Gosai, and you can check out the rest of our podcast. We have over 100 at rei.mba. Cheers.